As we hit the midway point of the first month of 2024, there has been a growing debate in the world of investment on the value of private companies versus publicly traded companies. And on top of that debate is a broader conversation about how much CEOs are paid and specifically how they are compensated. Is it possible that some of Canada's leading CEOs are making what many would classify as too much money? Joining us now to discuss those big questions in the world of investing is Thomas Caldwell, Chair at Caldwell Securities Ltd. Thomas, thank you very much for joining us.
Thank you, Julie.
Mr. Caldwell, we hear a lot of talk about private companies versus publicly traded companies. What's the difference and what is a better investment?
Publicly traded companies, you can buy and sell these shares on generally an exchange. They're what's called listed. So you can buy little bits and, come and go as you wish. Private companies are not generally available to the public. They're usually funded by more sophisticated investors with a view of becoming public companies at some point in time. Increasingly, financing in Canada is being done more and more in the private realm, primarily because the regulatory costs of becoming public relative to the size of the Canadian capital market, it's just too high. The demands in regulation, the demands in compliance are off the Richter scale. So companies find it easier, cheaper to raise. There's enough money around with high net worth individuals to raise the funds you need. The interesting thing about this, and again, it's one of the unintended consequences of overregulation, in that it used to be you could buy a hot new issue, like say Apple, which might triple after you buy it. There are no hot new issues anymore. What happens by the time a company goes public, that is, offers the shares to the public, that's the unload phase for the people like me who've been invested in the private component of that company for maybe years prior to there being a public offering. So it's taken away a lot of opportunities from the smaller investor. But like it or not, that's just the reaction to the costs of becoming a public company in Canada.
We hear companies talk about stock options. Can you comment on companies that grant too many stock options for executives? What level metrics is too much?
Well, Julie, let me share my prejudice. Any is too much as far as I'm concerned, because they always say we want to have options to align management's interest with the shareholders. No, it doesn't align them. They get a chance to participate in the upside, but if the company tanks, they don't participate in the downside. It's no cost to them. That doesn't align them with my interests. And very often, if you have a lot of stock options for management, you end up with management sometimes taking inordinate risk with the shareholders' capital investments. And if the thing blows up, there's no downside to them. And if it works, there's upside to them. So I think it's a lot. I chair a public company, Urbana Corporation. We have a simple rule: no options. But if a director or management wants them, we will provide a loan for them to buy stock. So they're on the hook like the rest of it. They will participate in the up and the downside. So I'd rather see them, with some money on the line, some skin in the game, as they say, so that they can participate both ways with the companies. But to have a free ride with no risk, that does not align you with the shareholders.
So let's talk about executive pay. There are CEOs that are being paid hundreds of millions of dollars for their salary. Is that justified?
Well, in a simple word, no. I don't care if you're the CEO of the world. You're not worth that money. I know the heads of probably most major companies in this country and many in the United States. And they're not smarter than the rest of us. They might have some good moves and have surrounded by good teams, good organized, lots of assets. I mean, not demeaning it, but we have several companies in Canada where CEOs are paid north of $150 million. That's totally insane. And that's I think, organized corporate theft from the shareholders. And, it does create a morale problem in a company, that it all of a sudden you have people struggling with their mortgages, and you got guys deciding which super yacht they're going to be buying. And I think that's wrong. I'll tell you something. Let me give you an idea. We bought a lot of exchanges years ago. We made a lot of money for our clients. I made a little bit for ourselves. And some of my clients bought some exotic cars with it, Aston Martins, etc. How could I do that in a company, say, of 60 people, buy an expensive car like that? That would create a dichotomy within our company, which is a microcosm of any company, where he's the rich guy with the Aston Martin or the Rolls. So I did. My prize was I bought a $15,000 15-year-old GMC pickup truck, which is fine with me. And I still love it's now 20 some odd years old. I love driving that old pickup truck around. So and everybody in the firm recognizes, the old guy bought himself a pickup truck, but I think it creates a team. We're in this together. This dichotomy of insane compensation and people struggling with mortgages and whatever, it's wrong. And it's going to end up with becoming a big problem for corporate management, because eventually governments are going to jump on that, and regulators will even jump on it when they can.
Thank you so much for your time today. I really appreciate you coming on the show.
Thank you, Julie. Have a great day.
You too.